Welcome to Money Mondays with Melissa, where we talk about financial empowerment while exploring financial assistance available through local, state, and federal governments, each month with a diverse group of subject matter experts. Chicago, are you ready to get financially empowered? Well, we've got just what you need. Without further ado, give it up for your Chicago City Treasurer, Melissa Conyears-Ervin.
Hello and welcome. My name is Rosalind Williams and I am a Senior Stakeholder Liaison with the Internal Revenue Service working out of the Communications and Liaison Division. Today, I'm going to be talking about the Schedule C and other small businesses. A little bit next, in this lesson, I'll be providing an overview of the Qualified Income Deduction, also known as QBI, which is an overview of the Form 1040, the Schedule C, Profit and Loss, and Business, and discuss how to calculate the gross profit and gross income, and to show you how to identify and deduct expenses and how to calculate net profit or loss. I'll also cover some areas of the Form 1040, which is the U.S. individual income tax return that may be of interest to small business owners. And I'll also discuss the employment tax and estimated tax, and I'll also provide references for more information. So let's go ahead and get started. Many individuals and owners of businesses operate through sole proprietorship, partnership, and S corporations, and some trusts and estates may be eligible for the Qualified Business Income Deduction, also called the Section 199A deduction. The deduction is found in tax law that was enacted in December of 2017, and it allows eligible owners of these businesses to deduct up to 20% of their qualified business income. Business owners can also claim 20% of qualified real estate investment trust dividends and qualified public traded partnership income. Next. Income earned by a C corporation or by providing services as an employee isn't eligible for the deduction. The deduction is available for tax years beginning after December 31st, 2017. Qualified business income, also known as QBI, is the net amount of qualified items of income, gain, deduction, and loss from any qualified trade or business, including income from partnerships, S corporations, sole proprietorships, and certain trusts. These includable items must be effectively connected with the conduct of trade or business within the United States. Next. Generally, in computing QBI, business owners must account for any deduction attributable to the trade or business. This includes, but not limited to, the deductible part of self-employment tax, self-employed health insurance, and deductions for contributions to qualified retirement plans, such as Simplified Employee Pension, also known as the SEP plan, Savings Initiative Match Plan for employees of small employers, also known as SIMPLE, and qualified plan deductions. Next. To complete a Schedule C, you'll first fill in standard information about yourself and your business. You'll also notice here that there's a place for you to enter a principal business or professional activity code. This is line 8. These codes are based on the North American Industry Classification System, and the Schedule C instructions contain a list of the 6-digit codes. If any part of your gross receipts is from the sale of products, you'll need to know all of the terms I am going to discuss. Next. So I'll be going over gross receipts and returns and allowances, cost of goods sold, gross profit and gross income, bartering, expenses such as car and truck depreciation, legal and professional services and office expenses, supplies, travel, meals and entertainment, and net profit or loss. Next. Gross receipts are the income that a business receives from the sale of its products or services. Returns and allowances include cash or credit refunds you make to customers, rebates and other allowances off the actual sale price. Individuals who don't make or buy products for resale as part of their business don't have returns or allowances to deduct from gross receipts. Next. Cost of goods sold is the cost to a business to buy or to make the product that is sold. It is easy to calculate the cost of goods sold if you sell all your merchandise during that same year. However, some of your sales will probably be from inventory that you carried over from earlier years, and you will probably have inventory left unsold at the end of the year. To calculate your cost of goods sold, start with the cost of the inventory on hand at the beginning of the year. Add the cost of additional goods purchased or manufactured during the year. Be sure to subtract the cost of any merchandise withdrawn for personal use, such as food a grocer may take home or gasoline a garage owner may give to his relatives. The result is the cost of items available for sale during the year. Then subtract the value of your inventory at the end of the year. Your cost of goods sold is the remainder. This calculation is part 3, cost of goods sold, in the Schedule C. Next. To calculate gross profit, first subtract the returns and allowances from the total gross receipts. Then subtract the cost of goods sold from the difference. Then add other income. This includes bartering income, which I'll talk about in the next slide. Gross income is simply the sum of gross profit and other income. See the instructions for Schedule C for more information on what counts as other income. Next. Bartering occurs when you exchange goods or services without exchanging money. An example of bartering is a plumber doing repair work for a dentist in exchange for dental services. The fair market value of goods and services must be included in the income of both parties. Income from bartering is taxable in the year in which you receive the goods or services. And you can also see this section on bartering in IRS publication 525, taxable and non-taxable income. Next. So now I want to talk about your day-to-day ordinary and necessary business expenses. Expenses must be considered ordinary and necessary business expenses in order to be deducted. IRS publication 535, business expenses, will go into more depth with that. Next. The first expense I want to go over is the car and truck expense. If you use a car for business only, you may base your deduction on the full cost of operating it. If you use a car for both business and personal purposes, you must divide your expenses between those used based on mileage to compute a business percentage. Do not include computing to and from your place of business as business mileage. You may take a deduction for your actual business expenses for the car or use the standard mileage rate. Next. Actual business expenses include gas, oil, repairs, insurance, depreciation, tires, and license plates. Standard mileage means multiplying your business miles by the standard rate. For this year's rate, please check the IRS website at www.irs.gov. To help reduce record-keeping burden, if you use no more than 4 vehicles at the same time for business purposes, you may use a standard mileage rate. However, to use the standard mileage rate on vehicles after the first year of business use, you must have used the standard mileage rate the first year. In later years, you can choose between the standard mileage and actual expenses. This option is not available to you if you claimed actual expenses in the first year of business use. Actual business expense include gas, oil, repairs, insurance, depreciation, tires, and license plates. Under either method, parking fees and tolls are deductible, and you can see Section C, Schedule C, for more information. Next, depreciation is the annual deduction allowed to recover the cost or other basis of business or investment property having a useful life substantially beyond the tax year. Depreciation starts when you first use the property in your business or to produce income, and it ends when you take the property out of service. You deduct all your deductible costs or other business, or no longer use the property in your business or to produce income. Do not depreciate land, inventory, or property you placed in service and disposed of in the same year. Next. So there are 2 main methods of depreciation: the modified accelerated cost recovery system and the Section 179 deduction. The method of depreciation, most tangible property, that is property you can see or touch, is the modified accelerated cost recovery system. It's commonly referred to by its initials MACRS and pronounced makers. The general rule of Section 179 allows taxpayers other than trusts, estates, and certain non-corporate lessors to elect to expense rather than capitalize and depreciate the cost of the Section 179 property they purchased and placed in service during the taxable year. Taxpayers can elect on Form 4562 to expense the cost of Section 179 property. IRS Publication 946, How to Depreciate Property, explains all about makers and the Section 179 deduction, what property does and does not qualify for the Section 179 deduction, and what limits apply and how to elect it. Next. Tax Cuts and Jobs Act, also known as TCJA, passed in December of 2017, and it made several significant changes to tax law which affect individuals and businesses. For example, TCJA of 2017 modified Section 179 for tax years beginning after December 31st, 2017. The new tax law increases the maximum amount to taxpayers may expense under the Code Section 179 to $1 million and increases the phase-out threshold, also known as the investment limitation amount, to $2.5 million. The $25,000 limit for the SUV remained unchanged. These amounts are indexed for inflation for tax years beginning after 2018. The TCJA of 2017 also made changes to the additional first-year depreciation deduction, which is often referred to as bonus depreciation. Unlike Section 179, which is subject to taxpayers making election, bonus depreciation is mandatory unless taxpayers opt out. The new law increases bonus depreciation from 50% to 100% for qualified property acquired after September 27, 2017, and placed in service after September 27, 2017, and before January 1st of 2023. The 50% bonus deduction rule will continue to apply to qualified property that a taxpayer acquired before September 28, 2017, and placed in service before January 2018. The TCJA of 2018 also increases the depreciation limitations for passenger automobiles used more than 50% for business purposes and placed in service after 2017, depending on whether bonus depreciation was claimed. So if bonus depreciation is not claimed, depreciation is limited to $10,000 in year one, $16,000 in year two, $9,600 in year three, and $5,760 in all subsequent years. If bonus depreciation is claimed, the depreciation limit for passenger automobiles acquired after December 27, 2017, and placed in service after 2017 is $18,000 for year one, $16,000 in year two, $9,600 in year three, and $5,760 for all subsequent years. These amounts are adjusted for inflation after 2018. The instructions for Form 4562, Depreciation and Amortization, provide general guidance on how to claim the deduction for depreciation and amortization, and make the election under Section 179 to expense certain property and provide information on business investment, use of automobiles, and other listed property. Next. The third and fourth expense are those for legal and professional services and office expense. Included in these expenses are fees charged by accountants and attorneys that are ordinary and necessary expenses directly related to operating of the business. Also included are fees for tax advice related to your business and for preparation of tax forms related to the business. In addition, under the category of office expense, include expenses for office supplies and postage. Next, supplies expense can be deducted to the extent consumed and used within a year. That includes the cost of materials and supplies, books, professional instruments, equipment, etc. If the usefulness extends beyond a year, you must recover their costs through depreciation. Next. Although Tax Cuts and Jobs Act of 2017 tax eliminated the deduction for any expenses related to activities generally considered entertainment, amusement, or recreation, businesses may continue to deduct 50% of the cost of business meals if the business owner or an employee of the business is present and the food or beverages are not considered lavish or extravagant. Beginning January 1st of 2021 through December 31st of 2022, businesses can claim 100% of their food or beverage expenses paid to restaurants as long as the business owner or an employee of the business is present when food or beverage are provided and the expense is not lavish or extravagant under the circumstances. Food and beverages that are provided during entertainment events will not be considered entertainment if purchased separately from the event. Next. For the travel part of travel and meals, enter your expenses for lodging and transportation connected with overnight travel for business while away from your tax home. The term tax home refers to your main place of business, regardless of where you maintain your family home. For meals expenses, enter your total deductible business meal expenses. This includes expenses for meals while traveling away from home or for business and for meals that are business related. Business meal expenses are deductible only if they are directly related to or associated with active conduct of trade or business, not lavish or extravagant, and incurred while you or your employee is present at the meal. Furthermore, instead of basing your deduction on the actual cost of your meals while on business travel away from home, you can use your standard meal allowance for your daily meals and incidental expenses. Under this method, you'll deduct a specific amount depending on whether you travel instead of keeping records of your actual meal expenses. Next. You must keep records, however, to prove the time, place, and business purpose of your travel. The standard meal allowance is the federal M&IE, that is the meals and incidental expense rate. You can find these rates on the U.S. General Services Administration's website at www.gsa.gov. You'll click on the per diem rates link, and from there, you can search by city and state or zip code. In most cases, whether you use the actual cost or the standard meal allowance, you can deduct only 50% of your business meal and entertainment expenses, including meals incurred while away from home on business. For more information on travel, meal, and entertainment expenses, please refer to IRS publication 463, Travel, Gift, and Car Expenses. And as I mentioned earlier, IRS publication 535, Business Expenses, tells you all about business expense deductions. Next. So next, we'll talk about net profit or loss. Net profit or loss is the amount by which the gross profit and any other income for a period is more or less in a loss than the business expenses and depreciation for the same period. To calculate net profit or loss on the Schedule C, you'll start with the gross profit, which is in Part 1, add other income, and that'll equal gross income. Then you'll subtract the total expense for the business on Part 2, business use of your home. Then you'll get the tentative profit or loss. You'll subtract expenses for business use of home. Then you get the net profit or loss, Part 2. Follow the instructions on Schedule C, should it be a profit or should it be a loss. You will report this profit or loss on Schedule 1 on your personal 1040, 1040 SR, and on Schedule SE. You can find more information on this topic in the business use of your home, as well as publication 587. Next. Now, there are a few deductions on the Form 1040 that we wanted to bring to your attention. The first is health insurance. If you're not covered by an employer's subsidized health insurance plan, you may be able to deduct 100% of your health insurance premium on Form 1040. This applies to an individual or a family health insurance plan. For additional information on health insurance deduction, please see IRS publication 535, Business Expenses. Second, if you were self-employed or a partner, you may be able to make a deduction on the Form 1040 for self-employed SEP, simple, or qualified plans. Also see IRS publication 560, Retirement Plans for Small Business for more information. Next. Business startup costs. Startup costs are amounts the business paid or incurred for creating an active trade or business or investing the creation or acquisition of an active trade or business. Startup costs include amounts paid or incurred in connection with existing activity engaged in for-profit and to produce income in anticipation of the activity becoming an active trade or business. Quality cost. A startup cost is recoverable if it meets both the following requirements. It's a cost business could deduct if they paid or incurred it to operate an existing active trade or business in the same field as the one the business entered into. It's a cost a business pays or incurs before the day their active trade or business begins. Next. So now let's turn our attention to self-employment tax and estimated tax. Self-employed people who are sole proprietors or partners in a partnership may be subject to self-employment tax. Self-employment tax consists of Social Security and Medicare taxes. When you are an employee, your employer pays half and you pay half. When you are self-employed, however, you pay all of it. If your net profit from self-employment is $400 or more, then you must file Form 1040, Schedule SE, self-employment tax. The IRS urges all employees, including those with other sources of income, such as self-employment, to check their withholding, which is a paycheck checkup. This will help you avoid any unexpected This will help avoid any unexpected tax in tax bill and possibly a penalty in the future. The easiest way to do this is to use the tax withholding estimator on www.irs.gov. Next. Finally, when you're self-employed, you may have to pay what is called estimated tax. You know that when you work for someone else, they withhold federal taxes with your pay throughout the year. Well, when you're self-employed, you take care of this by paying estimated taxes throughout the year. Estimated tax payments are used to make payments against any self-employment tax and income tax liabilities you will have at the end of the year that are associated with your business. A companion publication, 505, Tax Withholding and Estimated Tax, has more details, including worksheets and examples to help taxpayers figure out whether they should pay estimated tax. Among the taxpayers who should consult Publication 505 are those who have dividend or capital gains income, will owe alternative minimum tax, or have other special situations. Form 1040 ES, Estimated Tax for Individuals, can also help taxpayers figure these payments simply and accurately. To determine if you must pay estimated tax, use Form 1040 ES to estimate your taxable income for the year. Include your self-employment income and all other taxable income. You generally must make estimated tax payments if you expect to owe taxes, including self-employment tax of $1,000 or more when you file your return. Use Form 1040 ES to calculate and pay the tax. For more information on estimated taxes, see IRS Publication 505, Tax Withholding and Estimated Tax. If you or your spouse also receive salaries and wages, you may be able to avoid having to make estimated tax payments on your income by asking your employer to take more tax out of your earnings. To do this, you'll need to file a new Form W-4, Employees Withholding Allowance Certificate, with your employer. Estimated tax payments is easy now that most of the paperwork has been eliminated. The Electronic Federal Tax Payment System, also called EFTPS, makes it possible to pay online, over the phone, or through IRS Direct Pay online. You can learn more about EFTPS on how to file and how to pay electronically on IRS, www.irs.gov, and you'll click on the link EFTPS on the homepage. You can also go to www.eftps.gov. Next. Each year, the combined amount of wages, tips, and net earnings subject to Social Security withholdings changes. You do not have to withhold any more Social Security taxes once that combination reaches that limit. This is also known as the wage base limit, and this limit is published annually in the IRS Publication 15. If you receive wages in addition to self-employed income, then subtract those wages from the maximums to calculate how much self-employment income is subject to taxes. If you have income subject to self-employment tax, you calculate the self-employment tax on the Schedule SE. If you have more than one business, use one Schedule SE and combine the profits and losses from all your businesses. This applies to sole proprietors and partners. All of your combined wages, tips, and net earnings in the current year are subject to any combination of the 2.9% Medicare part of self-employment tax, the Social Security tax, or the Railroad Retirement Tier 1 tax. Next. So, as I conclude this presentation, we reviewed the basics of the Schedule C, including what business owners need to know to determine gross profit and income, to identify deductible expenses, and to calculate net profit or loss. We also covered some areas of Form 1040 that may be of interest to small business owners. Finally, we covered self-employment tax and estimated tax. Remember, more information on these topics can be found in the IRS publications referenced throughout the presentation, also including publication 334, Tax Guide for Small Business, and at the Small Business and Self-Employed Tax Center at www.irs.gov/smallbiz. And that concludes my presentation, and I have provided my contact information. So, Mikhail, I do need help. I can't see the screen with the questions. Okay, so the question that I have is, what's the deadline for businesses to file taxes this year? So because this topic is about small businesses where you can use the Schedule C, this would apply to the 1040 individual, including the Schedule C for their business on the personal tax return. So that would be the April 15th. So if you're looking to do it separately, that would be a 941, a Form 941, and those forms are filed quarterly. So I need to make sure that was the question that you're asking. Sean Johnson, if you're still there. And the other question was, is this just for small businesses? And in reference to that, yes, because this is the topic where if you have a business that you can include on the Schedule C, which is filed with the individual 1040 tax return. And then the other question is there a cap on the size of business? I'm not sure what you mean, but I can always, Sean Johnson, you can always reach out to me separately and I can go into more detail in reference to that question for you. Okay. And if there are no more questions, I just wanted to say thank you for having me and participating. And again, I did leave my information. If there are any questions after this, that you can reach out to me and I will respond.
Thank you for tuning in to Money Mondays with Melissa. We hope you enjoyed today's session and found value in the topic of discussion. Follow Chicago City Treasurer on Facebook, Twitter, Instagram, and LinkedIn to stay on top of all upcoming events. Remember, if you have any questions, feel free to reach out to the Chicago Treasurer's Office at 312-744-3356 or visit www.chicagocitytreasurer.com. We'll see you next time for Money Mondays with Melissa.